All right, guys, we are back. Camera's on. YouTube is working live. You guys are live. Are you alive? No. All right. Erica, you ready for the game? That's what it is. Switch clothes for the game. Okay. All right. Do this. All right. Let's see who we got. So Francielli, somewhere in the kitchen. Erica, Stephanie M, Yurika, Miguel eating. Francielli cooked for Miguel. Ingrid, Lima, Chris, almost done with the girls' room, setting up everything. I know, I see what you're doing. I'm gonna call you to assemble the stuff at my house next time, okay? I see Robin, Alondra, you're sideways. Fabiola, Vanessa, Verona, David, Yvette. All right, Jeffrey. Okay, now I see you. And Elena somewhere. Oh, there you go. Okay. And Bianca. Elena's charging. Okay, I saw it now. I saw your message now. I'm sorry. And Yvette, did the babies come? Do you think he was gonna be in class if he had the baby right now? Right? You would be in class? Wow, Chris. I'd be like, nah. There's always another session. I want to see if they come while we're in class. I want to see what you're gonna do. Mm-hmm. Talking. Mm. All right. So let's see what we got. Taxes due at closing. So there's state taxes on the deed and there's state taxes on the mortgage. So certain transfer taxes are due in connection with the closing appear and are accounted for on the closing statement. And these include state taxes relating to the deed and to the buyer's mortgage. In addition to state-imposed taxes, counties and municipalities may also impose a tax on real estate transfer. So state taxes on the deed. Deed is the document that transfers the ownership, correct? Deed is the document that transfers the house from one party to another. So if it's taxes on the deed, then it's called a transfer tax. Transfer tax, I'm sorry. So it's realty transfer tax. Pretty much all you need to remember is that even though there's calculations here, they don't ask you what it is. They're just showing you here that there's tables to assess the different taxes based on where the property is located, based on the type of transfer that it was, if it was a gift, if it was a regular transaction, if it was to somebody that's a senior, and so on. So every state, as it says here, has their own specific state realty transfer fee tax. might be a dumb question, says Muslima, right? And before I answer what I read on the question, the only dumb question I think I've mentioned several times is the one that's never asked. The one that you do not ask is very dumb. It's the worst question ever. Okay? The one that you ask, whether I have to repeat 1,000,000 times or not, is a great question. Unless you're Verona, because she yells at me for no reason. Now, what's the difference between title and deed? That's the question. The question that Muslima asked. Okay. So we'll go over it, but I'm gonna put it here real quick. There's deed. There's mortgage. There's taxes. There's construction liens, right? All this is title. Okay? So deed is the document that transfers the ownership. Mortgage is a document that proves that puts a lien and proves that you owe money. Taxes are monies owed to the municipality. And then there might be construction liens or easements or anything like that that comes after. Those all comprise the title. So title is all of these. Okay? Title is all of it. Deed is just a document that transfers ownership. But doesn't mean you necessarily had ownership rights because we needed to pull the title. Remember we talked about certificate of title, abstract attorney's opinion, all that stuff? Right? And even the other one that's very weird, the Torrens certificate. Right? So those are evidences of title. Why? Because they look at all the information to see if you even had the right to transfer the property. Right? So deed is just deed. Transfer. Title is everything. Good? Okay, great. Where were we? Okay, now state taxes on mortgage. Some states, not all the states, also impose a tax on the mortgage, recording fee, for instance. So most states do have that, and they bring it also down to the county records. So, for instance, Essex County has a separate registrar just for recording documents, but most counties have an in-house registrar. So somebody that registers all the land or public records, right? So there might be a realty transfer fee. It's almost guaranteed. And there might be a mortgage transfer recording fee, which in most states is also guaranteed. Now, so you guys can relax a little bit. I know we're still on page, out of this chapter, which is 21 pages, the chapter, we're still on page 13 of the chapter. But the cool thing is that from now on, it's mainly illustrations. All right? So we're going to have cartoons. We're going to have different characters playing, right? No. Illustration of the numbers. That's what we're going to have now. All right? So when we talked about selling terms before and closing costs, that's all we're going to see right now in the next section. Selling terms and closing costs. We started off by talking about the selling terms being what? The price that the seller and the buyer had agreed to, right? Whether there's a mortgage or not, right? The closing cost is the costs to close. So taxes, surveys, appraisals, all that stuff. And that's what we're going to see here. So in an example, Lawrence and Sandy Binder have accepted an offer on their house located at 928 Elm Street, Lilburg, and the buyers, Bill and Dillis Waite, offered $450,000 with earnest money of $70,000 and the remaining $380,000 of the purchase price to come from a conventional loan with Scepter Mortgage Company. Now, the loan is for 30 years at 5.5% interest with a monthly principal plus interest payment of $2,158. The lender is charging 1.5 points and 1% origination. And the closing is set to occur at Alta Title Company at 4 p.m. on May 10th of the current non-leap year. So, a lot of... hold on. Londra asked a question. Oh, I see you. Yeah, I see you. All right. I had difficulty finding you, but I see you. Now, what I was saying is here there's a lot of information. State exam, there's not going to be a question that has all this stuff in. They might use portions of this to make 2 or 3 questions out of this, right? But they won't put all this stuff in. The only reason why this is here is to show you how it would play. See, the binders now have an agreement to pay a broker's commission of 6% to Littleburg Realty. So that's what you're going to get paid. Their unpaid mortgage balance as of May 1st will be $184,000. Their monthly interest payments are $613. The annual rate is 4%, and so on, so on, so on. A bunch of information given. They're showing you here how this will be separated, and we're going to give you an example also of an actual closing statement, right? And here you go, selling terms. What were the selling terms? Well, $450,000, as we read, was the sales price or purchase price. The down payment or the deposit was $70,000, and the balance is the loan amount, $380,000. All right. I see Franciali is smiling already, so that means it's different numbers or a different page. I got it. But you found the page or no? No? Okay. Stephanie M., you're good? Okay, you printed. Okay, cool. So the next thing we have is seller paid costs. So part of closing costs, there's commissions. Oh, okay, cool. So there's commissions, 6% of sales price or 0.06. Real estate taxes are $2,572 to be prorated. Title insurance is $900 of the owner's coverage. Seller's attorney $1,500. Record lease deed. So as you can tell, basically without going through everything, as you can tell, they detail what the seller has to pay, right? They detail what the buyer has to pay. So if you look here, sales price $450,000, but they credited $70,000 because they had already given us earnest money, right? So these are the adjustments. $400,000, the buyer had already paid, as is usual. Before the company, the mortgage company appraises, they collect a check. $50 already paid by the buyer, so it's a credit. You see, these fees were already prepaid, so they show, even though they're itemized for the transaction, they show as credits because they were prepaid. Right? And all these adjustments and so on. So everything is going to be detailed in the actual closing statement. Okay? How do we figure out commission? Very simple. Gross sales price always. Gross sales price always. Right? Times the commission. So the commission was 6%. In this sale was $27,000. We're in Jersey, right? I'm in Jersey. Some of you are in New York, right? New Yorkers. Some of you are in New Jersey. Might be other states. But I'm in Jersey. This is now the current average, close to this. Here in the Ironbound, if you find something cheaper than this, good luck, right? A 2-family, 3-family, you're not going to find. 6% commission is almost 30 grand in your pocket if you sell one side and the other. But if not, again, 15 grand is not bad. And if you have to split with your broker at 70-30, again, still not bad, right? One sale, you walk away with almost 10 grand. Not bad. Yep, we have to split it. Yep. Why is the credit report so... Oh, okay, you saw it now? Okay. Alondra is saying, why is it so expensive? I don't know what you read, but now I'm curious. You read $350? Or the $400? $50. Credit report. Yeah. Robin has a question. All right, cool. Got background music as I'm waiting for Robin. So. All right, does the broker take a percentage of the sale or the commission? The broker gets $27,000. If there's a co-broker, so another brokerage, we're going to split this between listing broker and buyer or selling broker. Okay, and then you split this with the agent. But this is the amount that the listing broker gets, and then splits a portion to the buyer broker, so pays off the buyer broker by agreement. And the agents depends on whatever your commission split is within your brokerage. All right, taxes. We already talked about this before. Using the 365-day method, what are we going to do? Divide by 365 to figure out the daily amount. And then you multiply by the total number of days. So, because we closed on May 10th, this is an example for calculations. Because we close on May 10th, the total number of days is the number of days in January, February, March, April, and 10 days in May. So, using the 365, we're using the actual numbers in each month. So 31, 28, 31, 30, and 10, or 130 total days in that month, okay? In that period of time. So at closing, the seller's share of $916.50 is charged to the seller and credited to the buyer the same amount. Again, same amount. Very important. So how do we figure this out? The total amount due in taxes, just a quick review because we already did this before. The amount in taxes was $2,572. We figure out the daily amount by dividing by 365, and the daily amount is $7.05. How many days was the seller there? 130. So the seller owes the buyer, because it's unpaid, the seller owes the buyer $916.50. And the buyer will benefit from, will have to pay eventually the difference, which is $1,655. Who credits? The seller. Credits who? The buyer. Transfers to the buyer. And everything else is the same. Unpaid mortgage interest, if it's 1 month, then it's the previous month plus whatever days, because usually interest is in arrears. So what was the previous month to March? I'm sorry, to May? It was April. So they made a mistake here. It's 30 days. Anyway, so the data amount is 30 days, and it's that amount times the I'm sorry, my bad. We're talking about this month, May. So because we're talking about May, it is the 31 days. And how many days were unpaid? 10 days. So that's in the case that you're assuming somebody else's mortgage. Origination points. If they're asking you for 1.5 points, what do? We have the loan amount. We'll multiply the loan times the points. Okay, this is a origination fee. It's something separate. Most likely the question in the state exam is going to be based on points. So $380,000 times 1.5, $5,700 is what you have to pay in points. Again, these are just examples, easy to go through. It's one of the things I like about this book. Like, the book is very, very detailed, sometimes too much actually. But I do like the book because the way it has things laid out. What is the formula for points? Is 1% of the loan amount, never the purchase price. So in this case, how much was the purchase price? $450. They put $70,000 as a down payment. What was the balance? $380. That's why we're only calculating here, Erica. That's why we're only calculating on the $380 and not the $450. And by the way, all this information, guys, all this information is here. They detailed the whole transaction beginning to end right here. So this, if you were to go through an actual transaction right now, we would talk about all this going through the transaction, right? Do we need to calculate all these things ourselves? No, we just need to have an idea of how much it would cost the seller, or how much would it cost the buyer, how much would the seller get, or what credits would the buyer get. Have an idea. And that's why they laid it out for you. At the end of the day, who's going to put all this together? Mortgage and title company pretty much do, right? But you have to understand how it's calculated. So again, quick examples here. Escrow, where it says buyer's escrow, it says the lender requires the buyer to establish an escrow account to cover 8 months of real estate taxes and 4 months of hazard insurance. So again, escrow, it talks about taxes and insurance. Escrow, when it comes to mortgage, it talks about taxes and insurance. They're asking for 8 months of taxes and 4 months of insurance to be set aside just in case. So at closing, how much money must the buyer bring to cover that those amounts? Well, if the taxes were, based on what we read before, if the taxes were $2,572, you divide that by 12, right? That means that each month the taxes are $214.33, right? How many months is the seller requiring, right? So if this was a question in the state exam, how many months? They required 8 months of taxes. Well, each month is $214 times 8. The lender wants to make sure you have in a separate account, or you give them to be in a separate account, $1,714.64, right? What about insurance? They're asking for 4 months. How much did we say insurance was in the question above? In the statement above, the insurance is $2,400. You divide by 12, insurance is costing you $200 a month. How many months did they ask for? They asked for 4 months. 200 times 4, $800. So technically, just for escrow, right? You need roughly $2,500 to be set aside just for escrow, which is 8 months worth of taxes and 4 months worth of insurance. That's what they're asking to be set aside in this example. Nirka? See your typings. It's not as small as Vanessa's bottles, but works. Can I explain where the 1.5 points is coming from? So do you remember when we talked about the lender asking for potential points to reduce the interest rate for the lifetime of the loan? So the interest rate is 5%. You want to pay 4.5? Pay 2 points. That's what they're going to ask. So you're going to pay points up front in order to save 0.5 point for the lifetime of the loan. In this case, they told you the points were 1.5. 1.5 is 1.5 of the loan amount, not the purchase price. Good? You remember that? Okay, cool. Prepaid interest, we're going to skip. And we're going to go into... Wait, we already talked about TRID, right? This is where Verona yelled at me for not answering... well, it's the first time. For not answering Muslima. Right? Did you answer Muslima? Yeah, right here. TRID. It's only one more week. Then you get rid of me. Don't worry. All right. So TRID. Truth in Lending Act, RESPA Integrated Disclosure. So we already went over this several times in Chapter 17, today in the first half of this chapter, and now again. Well, the cool thing is that now I'm just showing you the actual forms. So it's like a summary. Here it's in green. I had it in yellow before. But now because we're in that section, I have in green repeating everything we said. So TILA, RESPA, Integrated Disclosures, has been in effect since October 3rd, 2015. And what they did was merge the forms and now requires that the lender gives the consumer a copy of your home loan toolkit at the time of loan application. After the loan application, so Verona, step number 1. After the loan application, step number 2. I'm just showing you what comes first, so you don't ask me again or yell at me again, okay? After the loan application is complete, then they must provide you, look, it's in bold. Again, I had marked before and put it in green as well, and now it's in bold, even in the book. They have to provide you the loan estimate no later than the 3rd business day after receiving the loan application. How do we know the loan application is complete? There's 6 pieces of information that must be provided. Name, income, Social Security, property address, estimated property value, and the loan amount that you're looking for. Okay? Now, right before closing, step number 3. Right before closing, these are the 3 requirements to the lender. Right before closing, they must provide you with the closing disclosure at least 3 business days before we actually close. So before consummation of the loan. When do we take over the loan? At the closing of the loan, which is usually the closing day. Bro, I know you get it. You know I'm just messing with you. Okay? I like to pick on people. You know that. Call me a bully. It's fine. I'll change my name from Instructor Bruno to Bully Bruno. It's okay. People still come back. Right, Erica? I don't know. I think we've gotten to a world where everybody's a little, you know, likes a little S&M. Pain and suffering, that's what it means. All right. Creditors are responsible for ensuring that the figures stated in the LE are made in good faith. So the loan estimate used to be called good faith estimate. So everything must be made in good faith and be consistent with the best information reasonably available to the creditor. So before, we used to have good faith estimate, settlement statement, and truth in lending disclosures. Now, we have one form, which is the loan estimate, and it operates the same way. It must be given to you, to the buyer, borrower in this case, in good faith. That means all the numbers here is what you should expect at closing, right? Again, could there be changes, as I said earlier in the first half? There could be changes, of course. But all the numbers I put in were done in good faith. Okay. Applicable transactions. So TRID applies to what? TRID applies to most closed-ended consumer mortgages. Closed-ended, that means you borrowed $100,000 and you have to pay it off. So the balance must reach zero. It does not apply to HELOCs. These are open-end credits, like credit cards. Like credit cards, they never end. You use, you pay back, you use, you pay back, you use, you pay back. So it's open, right? It does not apply to reverse mortgages, which you guys now know what a reverse mortgage is, right? Is when somebody's on a fixed income, right? When they're over 65 years of age, they're on fixed income, and instead of paying the bank, they get paid by the bank. Mortgages secured by a mobile home or loans made by persons who are not considered creditors. All right. So TRID rules, the LE and the CD, apply to almost all closed-end transactions, but does not apply to any of these. All right. So this is open-end. Reverse mortgages does not apply to it. Mobile homes does not. And if you're not a creditor, considered a creditor, like if I only help you one time, one person, one time this year in buying a house, I'm not considered a creditor. Okay? If I make 4 transactions this year where I lend money to 4 people, I'm not considered a creditor. 5 or more, I'm now considered a creditor. Okay? Sorry. You can find more information here on the actual TILA RESPA disclosure. This is the CD. We already talked about all this stuff, but I'm going to show you briefly what you can find in the CD. So if you see H25 closing disclosure form, it's CD. Every time in real estate we talk about the CD closing disclosure, we talk about LE loan estimate. Okay. Sorry, there's 5 pages in the CD. 5 pages. Page number 1 has the general information about the loan. So the property, the loan, projected payments, and the cost at closing. I'm going to show you in a second. That's why I'm skipping this. Page number 2 has description. So it goes more in detail of the closing costs. Description of the actual costs. What is paid to the borrower, by the borrower, by the seller, by others, and so on. Page number 3 has 2 sections. One is calculating the cash to close, so how much money must bring at closing. And the other is summarizing the transactions of the borrower and the seller. And you must get familiar with the LE and the CD because your clients will depend on you to explain it to them. Okay? And it's not that hard. So once you get it, it's not that hard. Page 4, additional disclosures regarding the loan. Okay, Francielli, I'm telling you, you only paid for one person. You're there highlighting while drying your daughter's hair. Seriously? She got embarrassed. Sorry, didn't mean to embarrass your daughter. I see everything. I'm sorry. All right. Next, page 5, the final page provides additional calculations, disclosures, and contact info. So let's go over the CD, an actual CD. It's better than reading all that stuff. So, you guys paying attention? Okay, good. Francielli just kicked the daughter. Like, get out of here. Let me pay attention now. 2-0? That's how much you're paying attention? You're watching the game? Go ahead. Come complain later. Go ahead. All right, so what do we find in the closing disclosure, guys? Look here. Whoever's in your room, kick him out. Whoever's in the living room, kick him out. Whoever's in the house, there's a place outside that's not that cold. Focus. Here's what we got, because you need to be able to explain loan estimate and CD to your clients. What do we find here? The date that this document was issued. The projected closing date, in this case, is the same. And the disbursement date usually is the same as well. So when are we going to pay? Who's the settlement agent? In this case, it's a title company. It could be a closing attorney, the buyer's attorney, for instance. The file number, the property, the sales price, everything is here. Transaction information shows the borrower, the seller, and the lender, and loan information. So it says that the loan is for 30 years. It's a purchase. So if this was a refinance, you would say refi as well. So whatever it is intended for, this loan, right? In this case, it's a fixed rate, conventional. Traditionally, the buyer, traditionally the buyer chooses the title company. In certain states, because the seller is the one responsible, the seller will pay for the title company. So, loan ID, right? And let's look at what we have here. Loan terms. What is the loan amount? $162,000. What is the interest rate? Remember this number? 3.875. And then we have monthly principal and interest. This is what you expect to pay in principal and interest. But this is just PI. Still missing taxes, right? PI was arrested at the time, so that's why we don't have him here. Prepayment penalty, we'll say if there's any, or if there's a balloon payment. In this case, it says yes. There's a prepayment penalty. State of New Jersey, we don't have that, so just let you know. But other states might have or might allow prepayment penalties. In this case, as high as $3,240 if you pay it off during the first 2 years. It shows the payment calculation. So here now includes the principal and interest, mortgage insurance or PMI. So here is PMI or MIP. In this case, because it's a conventional loan, we call this PMI. And also the estimated escrow, which is taxes and insurance, TI. Tax and insurance. What is your estimated monthly payment for this mortgage? $1,050.26. So far, why am I going over this? Because you should be able to review this with your clients and say, Mr. Buyer, Mrs. Buyer, this is what you were expecting, right? $1,050. This is what we saw before. It's within what we expected. If yes, we proceed. If something is incorrect here, then it needs to be adjusted. Okay? So make sure you guys learn how to go through this. Okay? Closing costs. Oh, yeah. I told you to hold on to that thought, right? The 3.875. I'm glad you wrote it. I'll show you in a second. Not there yet, but glad you remembered it. All right. Costs at closing. If you guys don't know how much the buyer must bring at closing, well, the LE is supposed to have similar numbers. The LE, which is given 3 days after the loan application, already says, hey, borrower, we're going to give you this much money. You need to bring this much as far as down payment. And there's also closing costs, which we estimate to be around this, $9,000, whatever, right? So this gives an idea. It gives you an idea of how much you need to bring. How much do I need cash at closing? $14,000. What is the $14,000? It's the cost of closing plus the balance of the down payment. Because remember, we already gave, it's going to be on the next page, I'm sorry. We already gave some money, the deposit, right? The earnest money deposit. So we need to come up with down payment, the balance of the down payment, and closing costs. After 8 years, no mortgage insurance. Where was that? That was in this type of loan, maybe. It's possible. Say, yeah, I know what you're seeing here now. It's possible that they removed the mortgage insurance because he reaches the estimated 20%. It's a conventional loan. So yeah, once he reaches 20% equity, I'm sorry, 22% equity, they must drop the PMI. If you call them up at 20%, they must drop the PMI. So here they're estimating that it takes 7 years for you to reach that 20% gap. So between your down payments and those payments along the years, from year 8 and on, no PMI. For FHA loans right now, for FHA loans is for the lifetime of the loan. So if that was your question, you need to get out of the FHA loan as soon as you can. That's all I can say. It's great as an entry point, but as soon as you have enough equity or property value increases, so increases your equity, or your credit is better, or income is better, switch. Yvette, this is automatically at 22%, but once you reach 20% of equity, if you believe that you have that 20% equity, you can call them up and ask them to drop the PMI. Yep. All right, let's go to page number 2. So as you see, page number 2 starts itemizing the costs, right? So they ask for points, application fee, underwriting fee, and they charge you for that right there. Okay. They charge you for appraisal fees, credit report fees, flood determination, flood monitoring, insurance, all that good stuff is right here. They charge you for the pest inspection fee. So like, for instance, termites, surveys, title insurance, lender's title insurance, settlement agent fee, title search, all these are charged right here. And that was buyer paid or borrower paid. Seller at this point has no expenses. Not these ones, right? No expenses. And right here, the seller has expense of $950, which is the transfer tax. That's how much the seller paid on this one. And then right here at the bottom, I know it's not very clear, but right here at the bottom is the reason you need to know. It's the real reason. Nothing else matters in these fees except the fees on line 5 and line 6 of section H. Can you see what those fees are? I don't know if you guys can read, but can you see those fees? Again, the only thing that matters, nothing else. We don't care about the client. We care about confirming that this is the commission we're getting paid, right? How much are they paying? We don't care. Notice the smirk, irony, sarcasm, whatever way you want to take it. Client first. This is a well-deserved paycheck for caring for our clients. Okay? That's the most important question here. I know. Stephanie M is typing. Your answer is different. I don't know. What did you do? Can I give you the mic? Yeah? He's doing calculations as I'm explaining this. You have to click. There you go.
So for the loan amount of $160, money on a pay bill, not even like follow this page.
So which page are you on?
I'm on the first line.
Here?
So am I calculating it wrong? I just added the 5%. That answer that I get, that's the interest that will be spread.
Yeah. So this right here, you cannot calculate unless you have the amortization table. So and we're gonna go over this. So this is over the 30 years. This is over the 30 years. You cannot use this number. And this I told you to remember because we're gonna talk about this number in a little bit. Okay. All right. Gonna mute you for a second, okay? All right. So Robin and Stephanie are ahead of the game. I'm getting there. All right. So obviously this was a joke regarding the real estate broker, but your commission is there too. So should you verify that your commission is correct? It's not the only thing that matters, but it definitely does matter that your commission is correct. So definitely check it out. All right. And we're going to keep on going. Here we calculate the cash to close. How much money must you bring and the reasons why. So the loan estimate was $8,054. Notice that it's the comparison, the differences between the LE and now the CD. So there's $1,000, $1,700 more on the final number. Very important to note that. Everything else appears to be the same, but there's credits here for seller credits and adjustments. So originally, this is actually a good thing. Even though the closing costs are higher, originally the buyer had to pay $16,000, bring $16,000 to the closing, right? But because of credits that were given by the seller and other adjustments, they have to bring only $14,000. Either way, the sellers and the buyer should be always ready for the amount of money that they have to pay or the amount of money that they receive. All right. And here's a list of all the pluses and minuses on the buyer side. They have to bring, as we said, they have to bring $14,000. On the seller side, how much money will the seller make? $64,000. Now the property sold for $180,000, but there's $115,000 in expenses. So let's see what these expenses are. $180,000 is how much they received, minus HOA dues. So the HOA was late, so 80, or it was for that period of time maybe, so that's $80. But they had a $100,000 balance on the first mortgage. So from the 180, we take $100,000. Then we also take $12,000, which are closing costs that the seller must pay. All right, so how much is due? Plus this $2,500 credit. How much is due from the seller? $115,000. All these little things. So again, everything's deducted and everything is adjusted to the T. Now 1 cent more, now 1 cent less. 180 is the sales price minus the things that the seller had to pay. How much did they walk away with? $64,000. So verify that with your client. Is this the number that we had spoken about for you to net? Very important. So it's close to it. Great. Let's move forward. If there's something wrong, let's see where it's wrong. Very important you know both the buyer side and the seller side. For state exam, this is not really the most important thing, but I'm preparing you for your career. It's very important to know how to read this one, the LE and the CD. They are very similar. And now, on the final page, page 5, let me wait for Robin's question real quick. Page 5 is where we're going to use that number that I told you to remember. We lost Jeffrey. Oh, there he is. Okay. Instagram does not count, okay? Doesn't count towards your hours. TikTok, definitely not either. I saw you had a little movement going on, so I'm not sure what he was doing. Anyway. All right. Robin's asking, I hate that. It's not a dumb question. Stop it. I'm going to start taking points every time you guys saying, oh, it's a dumb question. I'll take points. That's it. Does the buyer always have to put down a substantial down payment? This seems like a barrier of entry to young families. That is a great question. Here's the thing. The down payment would have been 20%. That's the traditional down payment. This is a conventional loan, so there might be a 20% down payment request. If it was an FHA loan, which helps young families, first-time home buyers, and people that are of low and moderate income, then the down payment would have been 3.5%. So in this case, 3.5% of 180,000, right, will be like 6,000 something. You understand? So that would be the down payment. But the closing costs are still there. So let's assume the closing costs are another $10,000. Can we talk to the seller and say, hey, Mr. and Mrs. Seller, could you agree to seller's concession where they contribute towards the closing costs? So these are part of negotiations to help potential buyers. If they don't, then we're going to ask the buyers, hey, do you have any family member that would be able to assist you by gifting the money towards the closing costs? You see what I'm saying? So there are several programs. If not, then there's like Newark, for instance, has a first-time home buyer program where they can credit, or had, where they credit you $8,500 towards the purchase of your first home. They give you an incentive. So if you had to come up with $6,000 plus $10,000 of closing costs, right? That's $16,000 minus the $8,500 credit, right? Now you're good. So you only have to come up with 7 something. So is this something that's always going to be there? I don't know. The credits might not be there, but there's always some new program coming up to help young families or people that are low moderate income. For all other scenarios, Robin and everybody else, for all other scenarios, we talked about NACA, right, NACA, and we talked about NJHMFA, and every state has a program that's sponsored by the state to help people start off with little to no down payment, right? And even subsidize the interest rate as low as 1% in certain areas. So there are great incentives. The problem is most salespeople, one, do not know, and if they know, they do not care. They want those vanilla clients that don't give them any worries, any headaches, because they got money. What people forget is that 80% of the nation qualifies for these special programs. So either you become the pro at the special programs, or you become the pro at the $1 million houses and no worries about it because people got money and credit. Totally up to you, right? But definitely not a dumb question. All right, so back to this, loan calculations. How much did we buy this house for? You remember? $180,000. On page 5, the final page is going to tell you the total payments. What is the total payments? $285,000. So wait a minute. We bought for $180,000. We put a down payment, and at the end is $285,000, so $100,000 more. The answer is yes, because the finance charge over the 30 years with an interest rate of 3.875 is $118,000. What was the amount we financed? Because we put a down payment, the loan amount was $162 plus the $118, $285. Now look at this number that's right here. I told you to remember a number before. You see a difference? This is the basic interest rate, the pure interest rate. But then something else is here, which Yvette already answered, and that is called APR. And APR includes the total charges to carry this loan. So APR is the number we need to look at. Did I borrow at 3.875? No. I borrowed at 4.174. That's the real cost of the money. You got it? And you see this number right here? Did you ever go to a restaurant and you buy something and they say, hey, food was great, service was great, here's what? Here's your tip. So yeah, thank you, bank, for lending money to me. Here's your tip. What is tip? Is the total interest percentage. So those $118,000 that we paid in interest over 30 years is the tip that we give to the bank. We paid 70% of the purchase in interest. Not bad, right? But again, it's over 30 years. All right? And all the details are here, like liability after foreclosure, if yes, if no. Who's your lender? Who's the real estate broker on the buyer side? Who's the real estate broker on the seller side? Who's the settlement agent? So as you guys can tell, oh yeah, there are classes. We have classes, first-time home buyer classes. You're more than welcome, even if you are in a different agency, I don't care. You're more than welcome to come join our first-time home buyer courses. Right? You bring your buyers, they listen in, they learn, and there you go. But here's something you need to understand. Both parties must sign before the closing in order to proceed, must sign confirming they received this form and everything is okay. Okay? They must sign everything. You guys good so far? Yeah? All right. So we went over the CD. LE is very similar. Again, make sure you are familiar with it. It's so important. It's so important for not only for test purposes, actually mainly is for real life, not test purposes, but it is important for you to know. Now, reporting requirements. So you know we must report to whom? IRS, right? So who must report to the IRS? Somebody. Anybody. As long as they report. It could be the seller's broker, buyer's broker, settlement agent, mortgage lender, or anyone designated by the IRS. So somebody must report to the IRS. What must be filed is a 1099-S, which is for the sale. And that is pretty much it. For your calculations, Stephanie M., we're going to have that as well in the math class. But we have, for you to figure out how much your monthly payment is. So that interest rate that you asked about, the 3.875, is the annual interest rate. What you want to figure out is how does the monthly payment relate to that interest rate? So how do we figure out the monthly payment? That's what it is. And for that, there's something called Amortization Table. And they will provide that to you at the state exam. I will show it to you in the math class, how to calculate the monthly payment based on information provided. So they'll tell you the loan amount is $100,000, interest rate is 3.75, and the term is 30 years. How much is the monthly payment? So by using that table, there's no other way for you to do this. By using that table or a special calculator, a mortgage calculator, you'll be able to reach the number. In the state exam, you cannot bring a mortgage calculator, you cannot bring a scientific calculator, so you have to learn how to use that table, all right? But that's in math, I will explain to you. Next. Any questions? Can I start the next chapter? No? Come on. It's only... Let me see how many pages next chapter. It's only 8 pages. But no. Alright, any questions? Erica's ready to go. Of course, she wants to go watch. See, 3-0. Congratulations. She wants to go watch the game. That's how much attention she's paying. And then there's an exam, and then she's going to be like, Colombia, oh no. Priorities. Just messing with you. But in all honesty, I keep on telling you guys, focus. Yesterday, Portugal was playing. You know what I was doing? Not watching the game. I was working on the website and making changes for you guys. Just saying. Can you take your house off an MLS once it's sold? I am a soccer lover. I am. I love soccer. Well, actually, I'm sorry. Let me translate that. Football. What? In America, no offense, but in America is the only place you call it football and you play with your hands. Oh yeah, that's true. I'll definitely not watch that. So Yvette has a question. Can you take your house off of an MLS once it's sold? Well, it will show as sold. It doesn't. It's not removed off the MLS because it was listed in that MLS, but it will show as sold, or closed, or expired, or withdrawn, whatever. By the way, my favorite sport is basketball, and not even that I've been following. I'm too focused on my goals to be distracted by sports. Insane. I'm giving time for Yvette to finish typing. There you go. My house shows full pictures of the interior, and I want to remove. You can reach, try to contact the MLS and see if they would, but usually no. Right? But you can try to reach that particular MLS where it's listed. Give it a try. Thank you, Nirka. This is why we have you here 27? Yes. 24/7. Yep. That's why people ask me questions at 2, 3 o'clock in the morning, and I'm there, one eye open and still answering. Yes. Notice that I said one eye open, not one eye closed, right? Actually, this is true. Last night, somebody was texting me questions at 2 o'clock in the morning, and I was answering. And this morning, woke up and gave more answers. I keep on asking. I beg you guys to ask me questions. I beg you. I need to go knock on your doors and say, hey, you have questions? No. Erica, nope. Yvette, are they in a different time zone? Nope. They're just desperate because the exam is the next day. That's what it is. All right. So, any other questions? Questions. Hit me with questions. Verona might actually hit me, so that's why I have to say with questions. Don't you be hiding your dinner over there. I see you eating. All right. All right, question from Yvette. What we got? You're very welcome. You need to find a broker. Oh, great question. Related. Thank you. So, do you need to find a broker to sponsor you prior to getting licensed? And the answer is yes, absolutely yes. Which is in the next chapter, but nobody wanted to start the 8-page chapter. So, the answer is yes. You should actually start interviewing brokers now and just let them know, hey, I'm thinking about a real. You don't even have to say you're in the class. I'm thinking about real estate career. Thinking about a real estate career. What do you have to offer if I were to join you? Simple. The reason why I'm saying this is that a lot of people, students, believe, oh, I'm going to wait until I'm licensed so I can speak to them and say, hey, I got it. Like you're embarrassed that if you don't pass the first time, and then they're going to keep on asking you. Simple. If I were to join your company, I'm thinking about a real estate career. You don't have to say that you're actually taking it. Okay? Erica, if it's a question about Colombia. No, okay. Too late. 30 minutes in. Yep. So you take the state test but won't get it? No, the state test is to allow you to activate your license. So with the state test and the fingerprinting, you bring that to your broker along with $160 here in Jersey, $160 application fee, which is to the state. And your broker submits that to the state to activate your license. So passing the test is just saying that you completed your course, that you understand the basics of this industry and this profession, and that you're ready to be sponsored and activate your license. Yep. And Jeffrey, yes, you can only work for one broker at a time. And you have to be loyal to that broker. So let's say Elena goes work for another broker, and you work for another broker, two separate brokers. You cannot be sharing deals like that, or sharing experiences in two different brokerages. So you have to be loyal to your broker. Yvette, you have up to 1 year. You have up to 1 year from completing the pre-licensing course. So as soon as you complete my course, I'll give you a certificate. Once you get that certificate and you go try to take the state exam, everything is based on the certificate date. So you have 1 year from the certificate date to pass. To activate the license, to pass and activate the license. But do you want to wait that long, or do you want to start making money next month? That's the question. Jeffrey, I've also seen a video that talks about Redfin. You can work for them by doing open houses, open doors for homes, people who need to inspect homes. Yes. So Redfin does that. Zillow just created open doors not too long ago, and it's going to be available as a full-blown brokerage as of January. And it's the same thing. These are online companies that will pay you for servicing that company. So what they do is they do referral agreements with other brokerages. And you get paid for showing doors or opening doors for Redfin as an agency. Have I had difficulty? Have I had students that had difficulty getting a sponsor? No. Everybody wants to recruit. It's just some agencies want full-timers only. Some agencies are okay with part-timers. So the difficulty that the students have is finding an agency that fits their schedule. But there's a lot of agencies that accept part-timers, right? So definitely not an issue. Verona, if you're opening doors for Redfin, for open doors for the Zillow company, if that's all you're doing is hosting open houses and opening doors, so showings, that's what you're doing, then you're getting paid either a referral fee or a management fee. But you're getting paid by Redfin. That means you work for Redfin. That's what it is. Robin, I was just going to ask how much Zillow is competition to the average broker. considering that Zillow is the largest search engine for real estate, even though they're completely inaccurate, but that's where people go to first. People don't know, right? So because they are the largest search engine, think about Facebook. A lot of people, instead of watching the news, they go to Facebook because it's just there. People just keep on posting, or Twitter, right? Those are the portals. You want to know something, you don't go to a library, you go to Google, right? So Zillow is the Google for real estate searches, or the Facebook for real estate information. So how much are they going to be as far as competition? Well, they could shut down Redfin. They could shut down all these other virtual brokerages, EXPs, and everything. They could, potentially. For the local brokerage, because we have an office and we're established, and we can say, hey, do you even know who Zillow is? Right? We can take a different stance on defending ourselves. These virtual brokerages cannot. They're going to have to compete of why should you use Zillow versus us in terms of virtual agency. So I don't think it's going to be like the biggest challenge to us. The only thing I see as a challenge to us is where they're offering the sellers, they're offering them, hey, you can either list with us or you can sell to us. That's going to be the issue, because you can sell your house to Zillow, and they even do the comparisons there of how much you would get if you were to list with them, or how much would you get if you were to sell to them. So of course they buy it from you at discount, but they do the comparison. If you sell to them, it's a quick transaction, they got the cash. If you list with them, it takes a little bit longer, so it actually costs you more over time. And that's I think is the thing that they have going on for them. Besides being the largest search engine where everybody goes, they go, boom, you want to sell tomorrow? We're done. That's it. That's how quick it could be. And I think that's what most people want. Close tomorrow, right? So obviously I'm exaggerating the closing tomorrow portion. It still takes a few days, but it's way faster than the regular transaction. Yvette, does a sponsor need to be licensed in the same state as you? No, you need to be licensed in the same state as your sponsor. Sponsor first and then you. So yes. So if you get a license also in California, then yes, you're going to be sponsored by a California broker. And you have a license in PA, yes, then you'll have to have PA broker to sponsor you. So you follow your broker. So you get a license in that state, you follow whatever broker it is. Robin, so it's more about relationships. Everything is about relationships. Any sales position is about relationship. Every sales position. Okay? Any other questions? Completely unrelated to closings, but I appreciate those questions. No questions? Once? Twice? All right. Then guys, have a great weekend. I hope you enjoyed this week, coming back from that week vacation. I hope you enjoyed this week. And next week, it gets even easier. Next week is easier, I promise. All right? So make sure you study. Reach out to me. You guys got my number. WhatsApp, it's the best method. So, or even Facebook. Reach out to me. If you guys are on YouTube watching, 908-418-8325. Make sure you send me a message on WhatsApp or check me out on Facebook, Instructor Bruno. All right? Not all. Thank you.